Welcome, traders. In this lesson, we're moving from individual concepts to a powerful synthesis. The title says it all: building Confluence. We're going to learn how to weave together three critical pillars: liquidity, indicators, and session timing, to build high-probability, low-risk trade setups. This is where strategy truly comes together. Let's start with the basics. What exactly is trading Confluence? Simply put, it's the occurrence of multiple, unrelated factors all pointing to the same trade idea. It's when your liquidity analysis, your indicator signals, and the market's session timing all align and tell the same story. Why is this so important? Because combining these factors significantly increases the probability of a successful trade. It's the difference between a guess and a calculated decision. Today, we'll give you an overview of these three key pillars. Our first pillar is liquidity. In the context of smart money, liquidity is defined as areas where a high volume of orders are clustered in the market. These are typically found at obvious, high timeframe highs and lows, the points where many traders place their stop losses and take profits. The core concept in SMC is that smart money hunts these liquidity areas before initiating major moves. They sweep these levels to trigger a cascade of orders, which provides them with the fuel and the opposing liquidity they need to push the price in their intended direction. Think of a liquidity sweep as the spark before the fire. The second pillar is indicators. We've covered this in depth, but let's reiterate their purpose within Confluence. They aid in timing and provide trend confirmation. Tools like moving averages, the RSI, OBV, and MACD are not the stars of the show. They are the supporting cast. Their job is to validate the story that price action and liquidity are telling. The golden rule, which cannot be overstated, is to use them as confirmation, never as your primary signal. They add a layer of evidence, not the foundation of it. The third pillar, often overlooked by beginners, is session timing. This is the art of choosing when to trade. The Forex market is driven by the major financial centers: London, New York, Tokyo, and Sydney. Why does this matter? Because when these sessions are open, especially during overlapping periods like London-New York, liquidity and volatility skyrocket. Higher liquidity means bigger, cleaner, and more reliable moves. Conversely, you should generally avoid low-volume periods, like the middle of the Asian session or weekends, as price action can be slow, choppy, and prone to false breaks. Trading during high-impact times means you're trading when the big players are active. So, how do we practically build Confluence? It's a clear, step-by-step process. First, we define our goal: the alignment of multiple, independent factors to find higher probability trades. The steps are sequential and logical. Step 1. Always start by identifying your key liquidity zones on the higher timeframes. Step 2. Once you have a potential zone, you then check for indicator confirmation: are momentum, volume, and trend flow supporting the move? Step 3. And crucially, you ensure the session timing aligns. Is this happening when the market is active? The perfect scenario, our example scenario, is a trade setup where all three of these pillars align perfectly. As the note on this slide perfectly summarizes, it's about finding the right area at the right time and place. Let's look at a hypothetical chart to see this in action. Here, we have a clear sweep of a structural low, followed by a strong bullish displacement that creates a fair value gap. The price then retraces right into that FVG. So, what are the key lessons from today? First and foremost, building Confluence increases your probability of success and, just as importantly, reduces your risk. You are entering trades with multiple layers of validation. Second, never rely solely on one factor. A single indicator, a lone liquidity level, or perfect session timing by itself is not a strategy. It's the combination that creates an edge. And finally, this requires patience and discipline. You must wait for the setup to come to you, rather than chasing the market. To close, how do you get better at this? You practice. Use a demo account to scan the charts, not for any trade, but specifically for these moments of confluence. Mark up the liquidity levels, note the session times, and see how the indicators behave. Continuous review and practice will hardwire this process into your trading psyche. Thank you for your time. Now, go build some Confluence.